Arizona's rental landscape in 2025 is at a turning point. After years of wild growth and frenzied demand, the market is now entering something quieter, more measured, a transition not from boom to bust, but from breakout to balance. Today, I want to walk you through that shift, what's driving it, what the numbers are saying, and how investors can position themselves not just to survive, but to thrive. Before you invest, before you commit your capital, you need to understand what's changing and why this moment is more strategic than chaotic. Arizona's rental market just flipped overnight. And if you watch this full video, you'll know exactly how to turn today's thin yields into future wealth, a shift most people don't see coming, but one the data already proves as of late 2025. The first layer of this story is demographic momentum. Migration into Arizona hasn't stopped. People continue to leave high-cost states, drawn by job growth, sunshine, and lower taxes. According to public forecasts from the Arizona Office of Economic Opportunity, the state is expected to add nearly 478,000 jobs between 2022 and 2032. That's roughly 1.4% annual growth. When jobs grow, people move, households form, and demand for housing, especially rentals, persists. So even as rental growth slows, the structural pull remains. But demand alone doesn't win deals. Let's add supply to this scale. In August 2025, the U.S. Census Bureau's Building Permit Survey shows Arizona authorized about 2,500 privately owned housing units. That's not negligible. New inventory is beginning to catch up with demand in certain corridors. More units means more competition for tenants, pushing landlords toward concessions and strategic upgrades. In Metro Phoenix, listings are rising. More vacant units are showing up. That means renters now have slightly more options than they did during the peak years. And that shift, small as it seems, pressures rental growth. Let's talk vacancy. Arizona's rental vacancy rate climbed from 7.7% in 2023 to 8.8% in 2024. That idea of vacancy creeping upward is vital. It tells us the market is loosening. Landlords used to expect near full occupancy. Now they plan for a buffer. In a looser market, concessions return free parking, waived deposits, short-term promotions. Those extras eat into yield. A building that used to command high premium rents now has to negotiate. And yet, while rents feel stress, home prices tell a different story. The FHFA House Price Index for Arizona in the second quarter of 2025 stood near 728.7. That's modestly above the prior quarter's 722.6. That tells us the ownership side is holding steady, not booming but not collapsing either. In some purchase-only measurements, the year-over-year change even registered slightly negative, a gentle pause, not a crash. Zoom in to Maricopa County. Home values are still above levels from 2023. Yes, they are off the peaks, but slip where slowly when fundamentals are intact. Risk is lower, serial declines rare, and owner markets tend to lag rent dynamics. So here's the pivot. In a rental market with shrinking yield potential, returns shift toward equity and long-term ownership. Cash flow matters less than compounding ownership gains over time. Let's walk through a hypothetical deal to illustrate this story. Imagine buying a suburban Phoenix home at $400,000, renting it for $1,800 per month, and estimating operating costs at 30% of gross rent. After vacancies, maintenance, taxes, insurance, and financing, your net might be between $4,000 and $8,000 annually. That's modest, a lean yield environment. Now factor in 10 to 15 years of accumulation. You pay down principal, housing appreciates, you lock in historically low entry. Even thin annual yield can compound to strong total returns if held carefully. The trick is you must plan for stress, not ride hope. In tighter yield conditions, investors need stress models. What if rents stall for 3 years? What if vacancy jumps to 10%? What if maintenance inflation doubles? You build in reserve funds, conservative assumptions, capital buffers. That's how you survive cycles, by having low-risk models, not gamble models. Micro markets matter more than ever. Neighborhoods near jobs, transit, schools, and amenities will resist yield compression better. Fringe areas with weak infrastructure or oversupply face downside. In Scottsdale, Tempe, and well-located parts of Mesa, rental demand and pricing hold more consistently. In newer outskirts or oversupplied corridors, the downside is sharper. Compare two deals. one in Tempe, close to transit and employment, another in a remote suburb with few amenities. The first accepts lean yield but gains reliability. The second might deliver higher yield in boom periods but suffers deeper losses when cycles turn. Now let's layer in financing risk. Mortgage rates today linger in the 6.4% range for 30-year fixed. That cost binds return margins. 1% difference in rate can swing net cash flow significantly. That means your leverage, debt structure, and term assumptions must be ultra-precise. Don't rely on easy refinancing or magical rate drops to bail out weak deals. Because returns are tighter, the art becomes in the optionality. Can your property adapt? Can it shift to short-term, corporate stays, or hybrid usage? That flexibility becomes a buffer when rental markets soften. Multifamily operators already test these blended models. Single-family investors who adopt flexibility types like short-term rentals, corporate lease partnerships gain optionality. Remember the time value of capital. If you invest now, even modest cash flow begins compounding equity. Wait for perfect conditions, and you might buy at higher cost and lose years of compounding. Many analyses show that early entry with conservative assumptions outperforms delayed entry over a decade timeline. Now, consider exit strategies. Owning long is ideal, but eventually you may sell or refinance. A property that held value and has resilient fundamentals will attract buyers even in softer cycles. That's why underwriting must focus on condition, management, and durable appeal, not short-term yield chasing. I must stress, in this environment, bad deals fail. Over-leveraged, aggressive assumptions, weak locations, those are the ones that crack. The survivors will be ones built on discipline, buffer, and flexibility. As we move into 2026, watch leading indicators: vacancy trends, new permit issuances, rent growth by micro-market, absorption rates. Those are early signs of where the cycle follows. If vacancy stabilizes or falls, yield pressure eases. If permits accelerate, expect competition. Arizona is not collapsing, but the nature of returns is evolving. For thoughtful investors, this isn't a time for panic. It's a time for clarity, precision, and long-horizon thinking.